Hi guys, welcome back to Father and Son Investing. The consumer price index numbers came out for the month of July this morning, and there's some interesting data in there that could affect your decision as to which type of Treasury bills you want to purchase over the next few days and weeks. In today's video, we're going to talk about that CPI data and what are some important highlights in there. We're going to talk about what the effect has been on the Treasury bill market so far after this data has come out. And then I want to present to you some information that you might not have received yet regarding what the future outlook for CPI and particularly inflation might look like, and help you decide whether you want to buy a long-term Treasury bill now. So let's get to it. All right, when the data came in this morning, it was kind of a good news, bad news situation again. The good news was that it came in less than expected. The bad news was that it went up compared to the June numbers. I'm going to borrow a chart here from the Wall Street Journal to illustrate this. You'll see two lines here. The core data here in this sort of magenta color, that came in at 4.7% year over year. Now, remember that the core data excludes fuel and energy, which can be very volatile. The overall data came in at 3.2%, and it was actually expected to be 3.3%, but you'll see here this little uptick here because compared to June, it was 3%, and then it went up to 3.2%. So that's kind of that good news, bad news. What does this tell us? Well, inflation has been falling steadily for the last pretty much year, and then all of a sudden we have this uptick here. It's only one data point, but I think it certainly gives a moment to pause and say, could this develop into a trend? I think that's what's going through the mind of the Fed committee members as they're thinking about whether to raise interest rates. Therefore, I think the numbers that come out in September for August are going to be key to whether the Fed wants to raise their rates in that September meeting. Now, I want to dive into the numbers just a little bit more. You're going to see here that for the month of July, inflation rose 0.2%. That's actually exactly what it was in June. So the month-over-month inflation data is holding steady there instead of that little upward blip that we saw year over year. We're going to take an even closer look here, and we'll see that the index for shelter was by far the largest contributor to the monthly all items increase. It accounted for over 90% of that increase. That's going to be important near the end of this video. Now, there is another interesting tidbit here in the data, and I want to point that out for you. It regards energy. Overall, year over year, energy prices are down 12.5% total, and for gasoline, we're looking at almost 20%, and for fuel oil, almost 27%. However, for this month, as many of you have noticed at the pump, certainly gasoline prices have gone up a bit, but look at this huge surge in fuel oil prices, 3% month over month. That's significant. Obviously, if something like this continues, that has a good chance of raising prices, inflation, as companies try to pass on their extra costs for heating or cooling to their consumers. Now let's just take a peek at what this announcement has done for Treasury bill prices today. I'm going to borrow from CNBC because the Fed data doesn't come out until 3:30 p.m. today. So we're going to get the real-time market prices here, and really you'll see that it's done pretty much nothing for the 1-month Treasury bill. And when we check in on the 1-year Treasury bill, we'll see that it's pretty much negligible as well. So the effects on Treasury bills for the market today with this CPI announcement is really just a flat line. Now I want to share with you something that you might not have seen yet. This just came out on August 7th. This comes from the San Francisco Federal Reserve Bank. All these Federal Reserve banks have their little specialties and things that they do. These folks at the San Francisco Federal Reserve Bank authored a paper here where they talk about some projections for where housing is going. Now remember, I told you that 90% of the increase in inflation was coming from the shelter index. It makes up a big piece of the pie when it comes to that overall CPI. And so a change in housing can have a huge effect on inflation. In fact, I've done a couple of videos talking about this, and I'll put links to those down below so that you can see the discussion about how this works. In their paper, they have an interesting graph that illustrates the effect of shelter on inflation. In yellow here, you have the core CPI inflation. Remember, core CPI is inflation minus energy and food because, again, those are so volatile month to month. Now, in green here, you're going to see the core CPI inflation excluding shelter. If we get this shelter inflation out, which is this one in this dark blue, which you can see is just way, way high compared to the others, you'll see that the Fed is actually getting quite close to their target. They're down below 3%, approaching 2.5%, if we can factor out shelter. So again, shelter is a huge, huge factor here when it comes to the inflation rate. So this is what I want to point out to you in this San Francisco paper. So you need to know that there is a significant lag in the way that CPI shelter inflation is calculated versus the real-time data. Here in this dark blue, you see the CPI shelter inflation, and all these other colors are referenced over here. They're the Case-Shiller Index, CoreLogic, Zillow, an apartment list rent index. And what we see is back in 2020, some of these started going up significantly, the CoreLogic and the Case-Shiller. It took until 2021 really for the apartment and the Zillow observed rent index to start going up. But notice how really the CPI index was not doing much. And then after these started to level out and even start dropping, the CPI index is still coming up here. So there is a significant lag. Now, the question is, there was this blip here where things started going up again this year, real time, at least on the Case-Shiller. These other ones went up slightly, but not quite as steeply. The question will be, is housing going to continue to go up, in which case it's going to be really hard to fight that inflation, or is housing shelter going to be coming down? And that's what this San Francisco paper addresses. Now, they talk about their methodology in this paper. I'm not going to go into that. But what you need to know based on this San Francisco model here is that they show the shelter index coming down significantly, really beginning in this year, which obviously it hasn't started doing that. So I guess we have to call into question some of the validity of their model, or at least the timing of their model. But they show that the housing index coming down significantly into early 2024 and continuing on into late 2024. Now, it turned out that they were a little worried that their data might be a little too sensitive, so they actually dropped the most negative effect on their cumulative forecast, and they recasted their data here. And we can see that it's not quite as optimistic for the housing shelter decrease as the previous graph I showed you, but still shows numbers coming down consistently out into 2024, sort of May or June, and then leveling off. So this data from the San Francisco Fed, or at least this projection of the data from the San Francisco Fed, is saying that housing should be coming down, that shelter index should be coming down, and therefore, because it makes up such a big piece of the pie when it comes to CPI, the inflation rate should also be coming down for 2024. Of course, as inflation comes down, we would expect that either the Fed will stop raising rates or potentially lower interest rates. And of course, if that happens, then the yield on future Treasury bills is going to decline. So that begs the question of, is it time to start looking at purchasing a longer Treasury bill or a Treasury note? Say the 1-year Treasury bill or the 2-year Treasury note. Coming back here to the graph on the 1-year Treasury at CNBC, we'll see that for the past 6 to 8 weeks, the Treasury bill rate really hasn't changed too much. We know from previous Fed meeting minutes that there is still a potential one more rate increase for this year. There was a lot of those Fed committee members that were talking about 2 more rates this year being increased. We've already done one in July. So there really isn't a whole lot more upside to potential yields from the 1-year Treasury. However, there may be significant downside, as I talked about, with the way that housing is projected to fall, at least according to those folks at the San Francisco Fed. So in my mind, I am now looking at locking in a 1-year Treasury bill right there at that roughly 5.35%. That's actually an excellent rate of return. It's better than picking a 1-year CD, and you can sell this at any time that you want. In fact, if interest rates do decline, the value of a 1-year Treasury bill will actually go up because people will be willing to pay you more for your 1-year Treasury bill that has a higher yield than they can purchase, say, at this time next year or in the spring. So potential double bonus here, you could lock in your rate if you're just going to hold it. Or if you think you might be wanting to sell it, you could sell it for more than you purchased it. Now, the same logic would potentially hold true for the 2-year Treasury note as well. In fact, the 2-year Treasury note has been a lot more volatile over the past 3 months, and you're actually looking at a really good yield here. I actually have been waiting for it to get to 5% before I went ahead and purchased, but I think I am going to be looking at purchasing a 2-year Treasury note as well. Same logic here. If the prevailing interest rates go down, then the price of your 2-year Treasury would go up because people would be willing to pay you more for a Treasury bill that will have a higher yield than what they can purchase on the market in the future. I hope this information was helpful for you. If it was, please give us a thumbs up, and please subscribe to the channel. And until next time, enjoy your investing.